Going back to compensation. So there are different frameworks, and my objective here is to give you a mental framework to envision your compensation framework, both from salespeople and non-salespeople, for executive and non-executive. So the first pillar of this mental framework is that the compensation framework is made by three elements: cash, bonus or commissions, and LTIP. That means long-term incentive plan. Um, the cash bonus is the base you use to calculate the rest of the compensation. Assuming that the cash compensation is $100,000 gross, the bonus is a percentage of the base. So let's imagine in this slide 50%. The LTIP, if present, and very likely, I mean, not everyone have an LTIP, which is the equity component. By the way, the equity component, it's an hidden cost because it's not a cost in the balance sheet, but it is because it's a way to compensate people. It's still a percentage of the cash bonus. In this slide, 50% of the cash bonus of the cash, of the cash base salary, it's also equity. So you will have $100,000 base cash, $50,000 achievable bonus, and $50,000 in equity. By the way, the equity need to be vested. Let's imagine a CEO salary, and this slide is meant to show you two things. First of all, that the CEO salary is not given for granted, and that the benefit of the compound effect of the long-term incentive plan give paid yearly. Okay, let's start with the CEO compensation package. Usually, when you read news on the newspaper, you have like, wow, this CEO is making a lot of money, which usually the CEO salary is a decent sized salary, but the number that appear on newspaper is misleading. Why it's misleading? Let's see what the slide says. If the CEO have $500,000 base salary, and let's imagine that this CEO have 90% of the base in cash bonus paid at the end of the year in April, and have 350% of LTIP bonus, so 1.75 million vested over 4 years, the total compensation is $2.7 million. So the newspapers say, oh, this is unfair. This CEO had $2.7 million. This is not true. Because, first of all, the cash bonus can be achieved or not achieved. In a bad year, this $450,000 is zero. And for the LTIP, if the LTIP is made only by option and not restricted to stock units, if these options are underwater, that means below the strike price, they worth almost zero. So a 2.7 million in a bad year where the stock price goes down and you don't get the bonus, it's $500,000 gross, that is a $250,000 net, more or less. So this 2.7 million that goes in the journal can be in your pocket $250,000 in a bad year. Let's analyze the compound effect of the equity. The compound effect of the equity is beautiful because create a lot of value for the equity owner. Let's imagine the equity granted every year for 5 years on 4-year vesting. You do see that in first row you have over these 1.7 need to be divided by 4 because it's vested over 4 years. So you have $437,000 every year one. So you have the shift for the year to grant. Let's imagine this on a 5-year period, $437,000, etc., etc. At the 5 year, if you decide to leave the company, you will get the full vested for 1 year, the full vested for year two, 75% of the vested year three because you are living on year five, and so you have vested only 3 years, two on year four, one on year five. That compounded is $6 million, which is amazing. So usually when you see your equity bonus, you say, okay, I'm getting, I don't know, $50,000 of equity bonus. But if you get it every year, it compounds and it creates a lot of wealth for the future. Another element you need to learn here, the compensation, it's a big topic and it's fascinating. I like it, but it's what happens if you are acquired by a private equity, and then the private equity give to the management what is called carry. What is carry? It's a percentage of the profit when your private equity firm will sell the business, let's say in 5 years. So let's imagine that there is an exit for $1 billion. So the private equity firm pays $1 billion. Usually they pay 500 million in cash and 500 million in debt. So, and let's imagine that in 5 years they will sell the business with 2.5 multiples. So, of the purchase price. So they sell it to 2.5 billion. The profit is not 1.5 but 2, because half a million is debt. So, and the debt usually is unloaded to the new buyer. So if you have 2 million profit and then the fund carry, which is the percentage that the fund keep for itself and not giving back to the private equity fund investor, it's 400 million, which is 20% of the profit. Usually 20% of this 20% is given back to the management. So management at the exit have to share $80 million, which is a meaningful amount of money. Uh, this is the standard compensation framework you should have in an Excel file as policy. So you have in the lines of the table the levels of the organization: C-level, SVP, VP, director, manager, contributor. And then you have, of course, SVP of IT team is different from SVP of HR team, etc., etc., etc. You have the cash component, and you start applying the percentages. The percentages can vary per role. So, if, for example, for C-level, the percentage is 60% of the cash bonus. Of the cash base, it's the bonus. 40% for SVP, 40% for VP, etc., etc. And also the LTIP changes per role. And by the way, it's not given for granted that people can get the LTIP. There are roles or levels that are not eligible for LTIP, or geographic region that have different policies. For example, Europe is less friendly to equity compensation. They prefer to overweight the cash component, and vice versa. In North America, they are more risk takers. That said, you have the starting point for every level is cash, and then you apply different percentages for different levels, both on bonus and LTIP. The bonus framework, it's a complicated thing because there are many variables, and the bonus itself, the structure itself, uh, guide the philosophical choices, the tactical choices, and the tactical choices of the company. So you can have both company KPIs and individual KPIs to evaluate the bonus. Company KPIs are the KPI that are common to the company. Usually can be EBITDA growth, very high level KPIs. And then you have individual KPIs. What is the difference? That company KPIs are shared between all the teams. Individual KPIs can be sometimes misleading because you can be an overperformer and get a huge bonus, over an accelerated bonus, when the company does bad, and vice versa. So what you have to do is to weigh the proportion. You can overweight companies' KPIs. For in this slide is 80% of the bonus and 20% is only on the individual. Why? Probably because this specific company that applied this framework want to push on all people in one direction, that we have to work together and not do your job the best, doesn't matter the result of the company. Uh, then there are also there is also another split at the uh, bonus policy level. let's focus only for example on company KPIs. So 80% of the bonus, you can split these in two parameters of the bonus: growth and profitability, where growth is 60% of the company KPI, which is so 60 of the 80, and profitability is 40% of the company KPI, 40% of the 80. So in this case, what we have is we are focusing a little bit more to growth than profitability, but profitability with 40% of the bonus component, it's it's meaningful. So also you do have minimum threshold. So what happens if we get the bonus? I mean, there are parameters like if we get 60% growth, you get 100% of the bonus. But if we get 50% of the growth and the objective is go 60, you get only 80% of the bonus. If we go 49, you got zero. On the other part, what happens if we overperform? That means if we do 120, 70% of the growth, you will have 120% of the bonus. And then if we do 71, you are still having 120%. It's capped. So there is the objective. That means in this case, if we get 60% growth, you get 100% of the bonus. Below 50, you get zero. At 50, you got 80. And then there is in the middle, what happens if it's 55, it's probably 90. And then if we get 70% of growth, so we overperform, you get 120. At 71, you still get 120. At 65, you get 110, etc., etc., etc. So the bonus policies are built to let the team focus on specific company objectives. Um, about the commission framework, I mean, bonus is given to everyone but salespeople. Salespeople get commissions. What means commissions? Means that percentage of the value of the product sold are paid to the salesperson at the end of every quarter. If bonus is yearly or can be yearly or quarterly, usually commission are quarterly because you focus on quarter result. So in this case, you have account executive one and two. Two different examples. Account executive one and two, they sell recurring and non-recurring product. The base is $60,000, the base salary. And then commissions. You have higher commission for recurring and lower commission for non-recurring because you want more recurring revenues. So you are guiding the salesperson to sell more recurring than non-recurring. And then if there is a percentage of the base on LTIP. So, same logic for if you want to sell more of one product than the other product. You get 5% for product one because you want to sell more product one, and 4% for product two. Product two. In this case, no LTIP. Um, so that said, as you can say, both bonus and the commissions are built to go to specific target. You pay more where you wanna go. You pay less if the other KPI is less important. Last concept, moonshot bonus. What is a moonshot bonus? What happens if you over achieve the target? Like the CEO of Uber said, okay, if we get I mean, the company probably was 10 billion evaluation, I don't know. And they say, if we go to 120 billion evaluation, which is 12 times the actual stock price, so you are creating 12 times more the value for your shareholder, you are giving me 136 million. It's called moonshot bonus, shot to the moon, very high, very likely unachievable target, and few people made it. Next chapter is professional services and how badly is set up the customer success into SaaS companies.